What's up, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to do some stock analysis for a stock that I hold called Pool Corporation. This is ticker POOL, and I started buying this stock in about April of this year. The stock has underperformed. It hasn't been a bad year for the stock, but it's definitely underperformed the index and the rest of my portfolio as well. But I got about 10 shares at $346 a share. Lately, the last couple of weeks, the stock's been moving up a little bit faster, but we're going to take a look at what this company does and why I am bullish on this company. So, if you don't know, Pool Corporation is the world's largest wholesale distributor of swimming pool and related outdoor living products, operating in over 420 sales centers in North America, Europe, and Australia. So they do, if we go to their presentation here, we can see that 61% of their sales was made up from retail and maintenance service, 17% came from new pool construction, and 22% came from renovation and remodel. So it's nice that they have these different revenue segments, and things like the maintenance and the services. That's something where everyone who has a pool has to get that done no matter what. So if we go through a bad year, a bad economy, maybe the number of new pool installations goes down, right? But the maintenance revenue should still remain the same. So that's what they do. Now, if we look at their revenue for the last couple of years, we're going to see that they have a nice trend of increasing revenue by about 17% per year for the last 5 years. Last year, they did $6.1 billion of revenue. Then we're going to go to net income, and we're going to see a similar chart with them increasing net income about 31% per year. Last year, they did $748 million of net income. And then keep in mind, this company is a $15 billion company, okay? And then if we go to their projected EPS for this year, we're going to see that from last year, the earnings are expected to come down quite a bit. But then in 2024, they're expected to pick back up. So we got a little over $18 of EPS last year. This year, it's expected to be 13, and then next year, it's expected to be 14. And I see that as again, because the last year or two, we've had some, rough times in the economy. That could be why there's been less pool installations and stuff hurting their revenue. So that's something to consider. But if we go back to my checklist here, we're going to see that their price to earnings is trading at about 27 times their 2024 numbers, okay? And here is their chart for the PE ratio. Right now, this is for trailing PE ratio. We're looking at a 28, and keep in mind, that's for 2022 numbers, most likely. And you can see that right around this 25, 26 is pretty much where it likes to hang out at. It normally trades between 25 and 30 times earnings. So I would say, you can make the argument that if you bought this stock at 25 times earnings, it wouldn't be a bad deal, but it wouldn't be a good deal. You'd just be pretty much paying fair price. So if you can get it, a little bit below, closer to 20, then you're looking at more of an undervalued stock for a company like this. But I'm still bullish. I still feel good about the price I got it at, and I think as long as the earnings keep going up, the stock should keep going up. So, is the company innovative? I wouldn't say so. This is not really what I think of when I think of innovation, so I'm going to give that a no. Strong market share. They are the number one in the industry, so I would say yes. The return on invested capital is 35%, and we can scroll down to the chart here to see that over the last couple of years, they're doing 35, 33, 36, 31, and 33. So all strong numbers there. Their goodwill, the balance sheet's not bad. They made an acquisition a couple years ago, and that added some equity to their balance sheet. But what I like to watch out for is the goodwill, because I don't like goodwill to be too big of a percentage of their assets or their equity. And what I mean by that is, as you can see here, the equity has gone from 400 million 4 years ago to now 1.4 billion. So it's what? That's a 3.5 times increase, right? 3.5x. So that's good. But at the same time, this big jump here, these big jumps in equity are large in part because of the acquisition they made, right? And so if we go to not this. If we go to the Goodwill, you can see it went from 200 million all the way up to $1 billion, right? So that's where I feel like that's a really big percentage of their equity. Their equity is only, it's barely over $1 billion, right? And we're talking about $1 billion of Goodwill. So that's where I don't really like that. But at the same time, they even without that, they still increase equity. So that's good enough. Is the equity minus the Goodwill over 15%? No. The share count is decreasing only by 1%, 2%, but still it's in the right direction. Are the assets minus Goodwill, of course, 1.75 times liabilities? No, which that's, most companies can't do that. Anyways, profit margin over 10%. Yes, they're at about a 12% margin. Cash and receivables, no. This one is kind of disappointing. We're looking at cash and receivables of only, I believe, 500 million. Let's see. Yeah, a little over 500 million as of 3 months ago. Okay. And this company's doing, well, I guess you could say, all right, let's do this. So they did do, their income was, around 700 million, right? But at the same time, let's see what they're doing this year. See, the income is going to be, might be a little bit lower, right? So let's say they do, what are they going to do? They're going to do 330. So they're only going to do, let's see, maybe 500, probably somewhere between 5 and 600 million. Let's say 550 million, maybe 600 million. That's probably what they're going to do for income this year. Okay. And if we, and their cash receivables is about 500. So it's almost, it's close. It's almost tied, but it's not more than income, and that's what we're looking for. The dividend, it's definitely not a big dividend. It's only a 1%, but at the same time, the payout ratio is 30%, and that means it's healthy. So that's really what we're looking for. And then we can also look at the history of the dividend. They've increased this dividend on average 19% per year. That's a lot. That's really good. So, if we go back, let's say 5 years, they were only paying a 37 cents of a dividend for each share, right? 37 cents 5 years ago. Now it's over $1. So it's pretty much tripled, right? It's nearly tripled in the last 5 years. That's really good. That makes a big difference for long-term shareholders. Then, is it over 20 years old? Yes, I believe 1980 it was founded. Growing free cash flow. Yes, this is another good chart. Let's change this back to annual. And then if we go to free cash flow, this is adjusted free cash flow, factoring in stock-based compensation, which honestly, it's probably in this case, since they're buying back shares, it's helping the free cash flow. It's making their cash flow look better. So we're looking at 420 million for last year, but overall, the last 5 years, there's generally an increase, right? We went through a pandemic, so that hurt the company, but they've recovered and it's increasing. So I'll give that a check. So overall, those are the reasons why I'm bullish. I think they have a strong moat. They have a good business model. They're in a good industry, right? They're in the pool industry. They have new pool installations. People are always going to want to buy pools, right, for the foreseeable future. And the people that do have pools need that maintenance done. So that's why that recurring revenue is always a good thing to have. And we're looking, I think on their presentation, they said since the IPO, they've averaged 29% annual returns for shareholders, right? So that's more than a 2x outperformance from the NASDAQ, okay? So 167% increase in the last 5 years. That's pretty good. And as you can see, this is another reason why I wanted to buy the stock. Now, keep in mind, earnings of course, they're coming down this year compared to last year. But for the last, we're going on nearly 2 years now that this stock has been, below $400, right? It's been $400 or below since May of 2022. So yeah, over a year and a half. And that's why I feel like it's time for the stock to start moving again. Now I think the earnings are probably headed in a better direction. And as we go to $13 EPS this year, $14 next year, let it keep going. I see no reason why it would slow down again unless we have another pandemic or something crazy happens. But yeah, I like the business model. I like the recurring revenue. I like that they're the number one player in the space, and I like the consistency in their net income, return on invested capital, all that stuff. The only thing I would like to see some improvement on is the balance sheet. Now, I mean, they do make acquisitions, so that can, have drastic effects on the balance sheet numbers, but that's kind of a good thing at the same time, because making acquisitions doesn't necessarily mean that's bad. So all in all, that is my bullish thesis for Pool Corporation. Comment down below what your thoughts are.